Good afternoon, everybody. Welcome to this webinar with Netwealth. I'm joined by my colleague Gary Horn, who is a financial planner at Netwealth, and my name is Fred Smith, and I'm also a financial planner at Netwealth. Between us and a number of our other colleagues, we form the advice team. So we're here to assist current clients with financial planning needs. We can provide advice for them, but also guidance, and also new clients who want to take advice too. Um, I believe everybody here is not a client, so welcome to Netwealth. Hopefully this presentation will give you a good idea of what we do and how we work, and how we can assist with your long-term financial planning. So it is 12:01. We have most people in already. I suspect some people will be joining in the coming minutes, but if we start, as we only have 45 minutes today, we'll try not to go over. We'll also try and answer as many questions as possible that people have sent in. So we have received a number of questions, a dozen or so far, but there is a chat function on this webinar. So at the top of your screen, you should have a question mark in a box. Do feel free to ask questions as we speak, and we will endeavour to answer those for you. Also, if you wanted to speak to us after this, our colleague Joe will be sending out a link to book calls. But also, you'll see on the screen now, there is an email address, advice@netwealth.com. So do feel free to drop us an email directly, and somebody from the team will get back to you as soon as possible and help. So without further ado, I will begin the presentation and hope you all enjoy it. So what is financial planning? Why is it important, and when might I need it? So financial planning aims to boost the effectiveness of your long-term planning with rigorous analysis of your financial circumstances and give you an advice report with clear recommendations designed to meet your various objectives and needs. So what we're really trying to do is optimize your wealth that you've built up over your lifetime, whether that's from working or inheritance or any other means. Perhaps you've sold a business, for example, and give you good recommendations to make the most of that wealth and boost your long-term position. And mostly that's about goal setting and asset allocation, and then using your various tax allowances in the right way, and then modeling that to show you what your position could look like over time. So why planning is important? I just want to show this brief slide, which is about the importance of investing. So as you can see here, cash in 2007 of £100,000, had it not been invested, the real value of that money would have gone down to about £65,000 at the end of last year. So clearly not investing is not a good strategy for long-term wealth growth. Investing really is the way to do it. So comparing that to a moderate risk level 4 portfolio. Oh, bear with me a second. I lost the screen. Just comparing that to a moderate risk level 4 portfolio. Although in that period there was a large financial crisis, so if you had invested then, you would have had an immediate fall. But if you stayed the course and stayed calm, that would have gradually recovered. So after 3 years, you start to see the benefits of investing. And the real value of that, after inflation, has grown over that time. So clearly investing is important, and working with an advisor can make you do that in the right way. So this is a very simple risk level 4. Working with an advisor, you may have a different strategy, but really it's about growing your wealth over time. So another adage, which you may have heard, is time in the market, not timing the market. So again, working with advisors can make you can help you benefit from being in the market. So as you can see here, from 1987, the US market, the S&P 500, has grown significantly. Had you been in the market from that day and just left it, and you might see there's various market falls. So here, the tech boom and crash. You have the financial crisis here. You have COVID here. There was also, the war in Ukraine and the high inflation as we came out of lockdown, which led to interest rate rises and market falls. There has been, clearly some financial crises, but generally the market rises, and it's always tempting when you're investing to be reactive. So sometimes if you see the market falling 5-10%, you might panic and start selling. That's not always a good strategy. Of course, if you can time the market, then that's fantastic. If you can sell at every peak and buy at every bottom, then you'll do fantastically. But the reality is it's incredibly difficult to do that. Even the best analysts in the world will not be able to tell you the perfect day to buy or sell. So time in the market really is the kind of the way that you can control that. So if you had missed the top trading days in that time period, just 10 days of those sort of 40, nearly 40 years, um, you would be still up 1,500% nearly. But if you'd have missed those, you would have missed out on nearly 3,500% growth compounding. So if you miss those top days, it can really have a big impact. So that's one of the reasons why buying and selling, trying to time it isn't always a good strategy. And working with an advisor can help you stay calm, understand the rationale, why are you investing, are you in the right asset allocation for you, and staying the course, because that's really when you get the benefits. So why might I need advice? So it's about planning your spending, achieving your goals, having a good plan that you can stick to and regularly review and make sure you're working towards it. Also, they're being flexible, so your goals might change. You might have a new objective, maybe your family grows, or you change jobs, or there's an unexpected high cost, or maybe your spending is changing. So you can work with an advisor to build a plan that's flexible and give you the peace of mind ultimately that you can achieve your goals. There are two types of advice. I'm sure many of you have been speaking to advisors, maybe at Netwealth and elsewhere, but broadly, every advisor fits into two categories. So you have restricted advice and independent advice. So, and most wealth managers are restricted advisors. So what does that mean? That means that they either provide their own products, such as Netwealth. We have our own investment solution, our own pension, ISAs, and general investment account solutions, and simple trust. Or you recommend products but from a specific provider. So maybe you're linked to an investment provider, such as a large investment company or something. But ultimately, you will be restricted to the products you can advise. That doesn't hinder the overall planning, because the financial planning point would be the same regardless of where you are. It's just that the solutions will be more limited. But in practice, and I've worked at an independent company before, and many people have, and maybe you've worked with them before. In practice, most independent advisors do have similar solutions, and they have relationships in the industry that they generally will put clients into. So in practice, both ultimately lead to very similar outcomes. The costs might be different. So restricted advisors do have the scope to be potentially more nimble and lower cost. Because you're providing your own products, your own investment solutions, everything's in-house, you can pass those efficiencies on to clients. So um, Netwealth does do that. So we have our own investment team, and we provide our own investment solutions. And that does mean that we can be lower cost than average and pass it on to clients. So ultimately, you keep more of your own money. But basically, those are the two things. I wouldn't say one is better or worse. A lot of it does depend on the quality of the people ultimately that are working there, and the quality of the advisor that you have, which we believe is very strong here. So we provide two types of advice, so one-off advice and ongoing advice. The reason we do that is ultimately we want to be flexible to your needs. So some people will want that ongoing relationship. So we build a plan at the beginning. We meet twice a year to review that plan, provide new advice as appropriate, um, and work with you over a very, very long time to optimize that plan. That is ultimately the most comprehensive service, and that's 0.35% per annum on top of the investment fees. But some people don't need that. So they just have a question they want to answer. Maybe they've inherited some money, they want to invest that, and they want some advice on how to invest that. But once it's invested, they're pretty confident that they can let that go. So they don't need to pay extra to have that ongoing advice. Maybe they just want a retirement plan, they're retiring next year. They just want to know what they can spend, roughly how much risk they should be taking, how to use their allowances efficiently, and maybe they'll review that in 3 or 4 years' time just to make sure they're still doing the right things. But they're maybe confident that they can manage the plan themselves. So that's one-off advice. That's charged at £200 per hour, and we would give you a fee quote and a scope of advice beforehand. So ultimately, we can give you what you need. Some of our clients start off as ongoing advice clients, and they switch it off and they come back. Some people start as one-off advice clients, and they actually decide they want the ongoing advice, and you can move between the two as you need. Um, so when we need advice, so navigating important life events, let's say maybe it's a career promotion, maybe you've received a lump sum, maybe you've got married or even divorced, maybe you're having children or you're thinking about retiring, there's some inheritance, or maybe you've got a large estate and you want to work with an advisor to help you gift that and give that away to children or grandchildren or charities or other relatives or friends, um, and sort of gradually save on inheritance tax. So there's some important life events which might prompt you, but ultimately that shouldn't be the only reason. Really, anybody that's working should benefit from advice because they can ultimately improve their long-term wealth position by investing appropriately and using their tax allowances. Um, so it's being smart, being efficient with how you're investing, um, and also bringing order to your plans. So many of us, maybe we've worked in a few different places. Maybe you've opened some accounts somewhere, an ISA here or an ISA there. You've accrued a few different pensions, and it's starting to get quite difficult to manage everything. So bringing order to your planning can be extremely beneficial. So that might be consolidation of your accounts and doing some transfers, and then having all of your plans in one place, and you can see that, and you can monitor that more effectively and make changes as needed. Ultimately, it just makes it a lot more efficient. So bringing in coherency can make a big difference. And that's often actually one of the biggest benefits, just simplifying your administration. Having one person that you speak to, one statement every year, you can see everything in the same place. You're not going through reams of paper, finding 4 or 5 different plans that you can't remember what you're invested in and whether you should make changes. So bringing order can be often one of the very biggest benefits, alongside the other benefits. What does advice cover? So all advice will review your circumstances. So what is your current position, your income streams? We will profile your risk. So what is your risk tolerance? So how do you feel about risk? Are you more risky? Are you more cautious? We'll review that and then make a recommendation for an appropriate asset allocation, which will be a combination of the equities, fixed income, the gold, other commodities, potentially some cash, some property. But also, it's about having the right asset allocation for your risk profile. We'll make recommendations for structuring your account, so using your pension appropriately, using your ISA appropriately, and other types of accounts. Saving efficiently, so using your pension allowances, making sure you're making the most of that, getting tax relief. Using your various ISA allowances, capital gains tax allowances, so making the most of that. How to draw down in the best way. So sequencing of returns is something that's actually really important when you're drawing down. If you're taking too much risk and there's market falls and you're crystallizing every month to take money out, you could be crystallizing losses, and that can amplify those losses. So it may be the case that you're not taking the appropriate amount of risk, and then if you're also drawing down in an appropriate way, that's going to compound those losses. So getting that right is going to be very important when you're drawing down. Modeling, so making sure that you do have a sustainable plan and that you are going to be ultimately spending what you can afford to spend, and that you don't run out of money at a certain point. So looking ahead, what's a reasonable amount that you can spend that your estate can generate, and working on that. Also, the estate planning, so how to make sure that your position at the end of your life is as sufficient as it can be, whether that's a combination of gifting in your lifetime to children to help them in certain key moments, maybe buying a house, or whether that's maintaining things like pensions, which are currently at least free from inheritance tax. And that may change. We've got a budget coming up, and Gary will talk about that. What we do not cover. So although we can point people in the right direction, we have relationships with other companies. We do not directly recommend insurance, but we do work with a broker who can help with that. We don't do tax reporting, so we won't help you file your tax return, but we can answer questions, and our advice will always take into account the tax position. We also don't do defined benefit pension transfers. So this is actually quite a highly regulated area. We do work with a company that we can introduce people to, but we don't personally make that recommendation. But of course, we take it into account when modeling various scenarios. And the benefits of advice, and sometimes it's good to see some numbers. There has been quite a lot of research in this area. One of the most extensive research was undertaken by the International Longevity Centre, and they produced a report which looked at how much better off people actually are from taking advice over time. What they found was that in a 5-year period between 2001 and 2006, people who took advice were £48,000 better off on average. The increase in the value of their wealth was 2,400% greater than the initial cost of their advice. So the initial cost of advice might be, £2,000, £3,000, £4,000, but ultimately, if your accounts are growing much more faster because of that, then it adds a huge amount of value. The value of their pensions were between 11 and 24% greater than those who didn't take advice, and their non-pension assets were also of greater value than those who didn't take advice by between 24 and 35%. What they also found was people who took ongoing advice were even more better off than those who just took normal advice, or one-off piece of advice, should I say. People who took regular ongoing advice and had meetings once or twice a year over a period of time were 61% better off than those who took no advice. So you can see quite clearly how taking advice does add value, and particularly over long periods of time. And one of that is too. It's also about using your making sure that you're staying abreast of regulations, tax changes too, which an advisor can assist with. And before I pass over to Gary, I just want to go over a case study. So this is loosely based on one of our clients, so of course anonymized. So Mr. and Mrs. Smith have an estate worth about $2.5 million. That's investable assets. They're looking to retire in the next 12 months, and they want to see what they can achieve. So their main question is, can they spend £100,000 a year, and also gift to their children? Also have some initial spending at the beginning of their retirement for some house renovations and a holiday, or a large holiday that they've been waiting to do for a very long time. So they also wanted to make sure they're investing tax efficiently, of course. They also wanted to have their assets managed on their behalf by a professional, so they can kind of relax and not worry about that, and they can focus on enjoying their retirement. And they wanted to leave an inheritance for their children and grandchildren. So the first thing we did was compared their current costs and charges. We can see that they're paying just over 2% to their current advisor, whereas at Netwealth they could reduce those costs significantly by nearly 1%. So 1% a year on 2.5 million really does add up over time. Ultimately, you keep more of your money by having lower charges, and that's the main aim, without compromising service too. So we compared our costs and charges, and this is quite typical of clients that come to us from other wealth managers or advisors. Typically, they are paying more, whether that's more for the investment funds, whether that's more for advice or investment management, or whether that's more for a platform fee. So we don't have a platform fee as we manage our own investments, but other advisors who may be independent advisors who don't have their own platform will be paying an external provider to hold the investments on their platform. That might add another 0.2 or 0.3%. We also reviewed their asset allocation. As you can see here, they're mostly in equity, so it's quite a high risk strategy. But they're also very overweight to the UK, so about 32% in the UK market, compared to about 20% in our portfolios. So quite imbalanced and quite a home bias, which ultimately can add to risk because you're very exposed to one single market. The other diversification was quite weak. They didn't have very much in other asset classes. And as people about to retire, taking that amount of risk might not be appropriate given they're going to be drawing down. So we reviewed all of that. We created a report which basically recommended transfers. We recommended a new investment strategy. We reviewed their risk profile, so they weren't taking as much risk. We actually brought them down to a moderate level of risk, so kind of risk level 4. We looked at how that they should crystallize their pensions to make sure that they use the tax-free cash appropriately. We also made sure they were using their various tax allowances between them, so the ISA allowances and also using their various allowances in their general account, so using their CGT, capital gains tax allowance, also dividend allowances. And then we modelled that to demonstrate that they could achieve their goals. We factored in as well gifting over time, and we also factored in a one-off withdrawal for their renovations and their holiday. Just very quickly, our portfolios range from 1 to 7. So in this scenario, we brought them into a 4. They were coming from around a 7, but in practice, for simplicity, we're showing here as a 4, but in practice, it may be that you have a blend of risk. So for short-term assets, maybe in your general investment account, which will typically draw down first, you might be taking less risk, maybe a risk level 3 potentially. For longer-term assets, which you aren't going to be touching, maybe it's a pension that you will never need, taking more risk might be appropriate. And ultimately, what that does is it increases the potential for return. It does increase the risk of loss, but in short time periods. So over periods of 10 years or more, it's very unlikely that markets would fall so that your position is worse off than when you started. In shorter time periods, the risk of that is very high. Over time, the market does tend to rise. So taking more risk when you have a longer time horizon is generally sensible, unless there's a very good reason not to. For short time periods, when you need the money in very short time periods, taking less risk is generally quite sensible. So we produced a projection before and after advice, and what you can see here, so without ongoing advice, so without any optimization, they just put it in risk level 4, and they just take money from their pension up to their basic rate tax band, and they take the rest from their other accounts. So very simple, something that a lot of people do implement. You see the position is very strong. So they're gifting money here initially, so that it is falling. But then when they downsize their house, more money comes in, so that reduces their estate initially because they're buying a smaller house. They're investing that, and then they can gift that or spend it. But without any advice, you might think, "Oh, great, my money's grown to 3.6 million. I'm in a very strong position," and that is ultimately a good outcome. It's not a bad outcome at all. But what you'll notice here is the distribution of wealth is, although mostly still in their pensions, they do still have 15% in ISAs, which is ultimately going to be charged 40% inheritance tax. So ideally, you want your final wealth to be in pensions or spent. If we look at the next projection with advice, so after the recommendations, after optimizing, using their tax allowances appropriately, what we actually did was took less from their pensions. So we didn't fully utilize their basic rate tax band because we calculated that if they took about 35,000 from their pensions rather than 50, that would mean that they could spend their ISAs down by the end of their life and ultimately have a smaller final inheritance tax bill. So you can see the biggest impact is probably here, the distribution of wealth. Only 2% of the remaining wealth is in ISAs at the end, so that's saving a significant amount of inheritance tax. The majority is in the pensions, which are currently free from inheritance tax. Also, their wealth has grown more, so to 4.4 million, because we've used the tax allowances in a more efficient way. Just quickly to compare that again, 3.6 million versus 4.4 million, so £800,000 more. But also 15% before was in ISAs, which is about £500,000. Tax at 40% is about £200,000 or so of inheritance tax on the ISAs, compared to 2% in the ISAs. So a much smaller final inheritance tax bill of just in the sort of double digits as opposed to triple digits. So in the tens of thousands of pounds rather than in the hundreds of thousands of pounds. And that's assuming no additional gifting, which clearly they can do. So hopefully that gives you just a kind of a taste of type of advice that we can do and how we can assist. I'm now going to pass over to my colleague Gary Horn, who will also do another case study and take you through the rest of the presentation. Thank you.
That's great. Thanks very much, Fred. So yes, good afternoon, everyone. So I'm now going to take you through another case study. So just bear with me whilst I share my screen. Okay, there we go. Great. So I'm going to be focusing now on another particular area of financial planning. So this is relating to the lifetime allowance. So many of you will know that the lifetime allowance was actually abolished at the start of this tax year. However, it does still have significance for clients in terms of their current and future financial planning. So and the reason for that is essentially, even though the lifetime allowance has been abolished, there's still a reference point in terms of the maximum tax-free cash that a client can take. So just as a reminder, the lifetime allowance was essentially a limit on the maximum amount which a client could accumulate within their pension before facing a punitive tax charge, so a lifetime allowance tax charge. That no longer applies. It's been abolished. However, it is still relevant because of the tax-free sum. So just as a reminder in terms of the history of the lifetime allowance, so it was introduced back in 2006, 2007, so the 6th of April 2006, A day. It was initially 1.5 million. That was the level it was introduced. And then over time, the subsequent years, it was increased over time until 2011, it peaked at 1.8 million. And then subsequent years, subsequent governments, it was cut and reduced until such time in 2016-17 it plateaued, and then gradually, just for a few years, was increased by inflation until it was fixed at the end lifetime allowance when it was abolished, which was 1,073,100. So that was the standard lifetime allowance. Now, just to emphasize the point in terms of the reason for showing this and then the importance is someone back in 2011, 2012, if they were eligible, so essentially if they'd had a pension which was of a relevant size for them to be able to apply for protection, they could have applied for fixed protection 2012, which would have essentially meant they had a protected lifetime allowance of 1.8 million. And for that client now, essentially their maximum tax-free lump sum, so the lump sum allowance it's now called, would be 25% of that. So essentially the maximum amount of tax-free cash that client can take over their lifetime is 450,000. Okay. Now that contrasts with someone that hadn't taken that protection, hadn't been advised to do that, and then essentially when they come to the point of needing to access their pension and taking the tax-free cash, let's say they've done it in one of the latter years or now, they'd actually be only able to take the standard lump sum allowance, which is basically 268,275. And if it's not obvious, that's essentially 25% of the end standard lifetime allowance. So the main point of this, in terms of just showing us it is really just to demonstrate the importance of having advice and how much it can play a part. So in this scenario, the person that hadn't taken advice, hadn't applied for that fixed protection, or certainly hadn't done this themselves, would only be entitled to less tax-free cash, 181,000 tax-free cash, contrasting with the one that had taken advice, and all of that now would essentially be subject to income tax when withdrawn. So quite a big difference in their position. That now leads me nicely onto the next slide and the next case study. So this is also connected with the same or similar subject area. So since the abolishment of the lifetime allowance, a new piece of legislation has been introduced. Not many clients will necessarily know about this, but this is essentially the transitional tax-free amount certificate. So following the abolishment of the lifetime allowance, what one can now do is essentially apply for this tax certificate, and what this can potentially do for a client is increase the amount which they are able to take over their lifetime as a tax-free lump sum allowance, as it's now called. So in this particular scenario, in this case study I'm going to use, we've got a client called John. He basically took out fixed protection in 2014. So essentially it means he had a protected lifetime allowance of 1.5 million. The relevant point being now is that his protected maximum lump sum allowance, tax-free allowance he can take over his lifetime is 25% of that, so being the £375,000. John has previously accessed parts of his pension. So basically in 2014, he crystallized part of his private pension. So he crystallized 750,000, which basically used 50% of the LTA at the time. He took his 25% tax-free lump sum from that pension, which would be a typical action a client would take. In 2017, he also accessed part of his final salary pension, or accessed all of it, and that was a deemed crystallization value of 375,000, and that therefore used 25% of his lifetime allowance. Now, the summary of that is basically those two actions used 75% of his LTA, and he'd taken 187,500 of tax-free cash from those actions. Now, the default assumption, without any application for the TTFAC, is that basically John would have utilized 75% of his LTA and basically taken the full 25% of tax-free cash from that amount. So it's without any action, it's just assumed that John's basically taken 281,250 of tax-free cash. Now, We know that's not the case. John only actually took the 187,500. So basically, what John can do, uh, he can apply for the certificate, evidence that he's only taken that sum, and basically the consequence of that is essentially the amount of tax-free cash that John can then take over the course of his lifetime is, rather than the default assumption being that he's only got 93,750 remaining, i.e. his lump sum maximum allowance plus the default tax-free cash amount, he's now actually basically 375, taken the 187,500 and still got this 187,500 of tax-free cash remaining that he can take. So essentially, as a consequence, he can now take an additional 93,750 of tax-free cash, and ultimately, that if not doing so, that would all be subject to income tax, as I sort of mentioned on the previous slide. So, as I've said, this is like quite a niche area. It's new legislation which was rushed through before the start of the tax year. Not many clients or people will know about this, but can clearly make a huge difference to someone's situation. If clients need to talk about this, please get in touch, and we're happy to talk around your situation and help you with those applications if you need it. The one thing I finally just would stress on this: it's not always in the best interest for a client to make that application, and then actually sometimes it can result in worse outcomes in terms of tax-free cash, and usually that's when someone's made crystallizations at a time when the lifetime allowance was higher. So it's just important to be careful and just don't go into making such a decision blindly. So just moving in onto the next slide. So clearly lots of changes potentially ahead. If you've not read about it, lots of talk in the press at the moment, but we've obviously got a budget, Labour's first budget, on Wednesday the 30th of October. Much speculation in the press at the moment in terms of what may or may not happen. The first item, it's already been announced in terms of that's now going to apply to private school fees. So we've had lots of conversations around clients as to what that means for them. Clearly, that cannot be avoided, but that does impact on clients' planning and how they fund those school fees. What's the best way for them to do that? They're clearly going to need to put additional sums aside to fund those school fees, and what's the best way to be investing those funds? In terms of what's going to happen or not happen in terms of the changes, we clearly do not have any crystal ball in terms of the changes, but that doesn't necessarily mean that clients should be taking certain actions in certain scenarios. So just to sort of give you an idea of the potential areas of changes which you may have read about, is there's talk around the potential reduction or abolishment of the tax-free lump sum entitlement. So recent conversations with clients regarding that is, should they take it now ahead of the budget or not? For some, it may well be the right course of action, and usually that tends to be if it's something that they're considering doing it anyway in short order, and therefore potentially bringing forward those plans. For others, it may not be the right thing. If they were never going to be touching their pension anyway, it may not be the right thing, because essentially in such a scenario, they're essentially bringing that tax-free cash back into their estate for IHT purposes. So these are the sorts of things we can talk to you about if you get in touch. Potential reinstatement of the lifetime allowance, which talked about earlier. On the day of the spring budget back in 2023, when the Conservatives were in power, they obviously abolished the lifetime allowance. On the immediate response from Labour was that they would reintroduce the LTA. They've subsequently been more mute on that subject, and actually bringing back the LTA would not be as simple as just it wouldn't be a simple process. It would require lots of rewriting that back into legislation, and obviously potential transitional arrangements for people who've crystallised, but it's certainly something to consider. Another area has been talked about, speculated in the press, is whether there's any reduction on the tax relief on pension contributions. So as it currently stands, contributing to a pension is very tax efficient. Investors, as a contributor, you get marginal tax relief. Tax relief at your marginal rate of income tax. So there's been talk about whether that might be reduced to some sort of flat rate, maybe 30%. So again, we don't know, but if someone's going to be making a pension contribution, it might be something they wish to do and can accelerate ahead of the budget. Another area is the inheritability of pension. So as it currently stands, pensions are very useful from an estate planning perspective. Pensions are completely outside of the estate for IHT purposes, and very useful in terms of passing on wealth, in terms of the taxation of death benefits. So we don't know, but it's just worth something bearing in mind, and we're obviously keeping on top of that in terms of advising clients what they should do. Another area which is popping up quite a lot now is a potential increase in CGT rates. So currently, as it stands, CGT rates are far more favourable compared with income tax rates. So CGT rates being 10 and 20% for basic rate and high rate taxpayers respectively, versus 20% and 40% for income tax. In terms of what does it mean for clients, again, it just depends on a client's position and what the right course of action for them is. But just to sort of give you an idea of some scenarios that we've recently had, is a client may have been considering certain actions in short order in the not too distant future. For example, they may have been considering some gifting to their children, and therefore it may be that they accelerate those plans in order to crystallize the gains at the current CGT rates, as opposed to potential future higher rates. CGT rates are historically low, and also low compared with other domestic countries. For those old enough, CGT rates did actually used to be aligned with income tax rates. Another conversation, we've had clients that are wishing to move to Netwealth, that they've made that decision. Their existing portfolio has large unrealized gains. They need to be crystallized, and just making sure they take that action before the budget, just to make sure they only pay at the current CGT rates. Finally, a wealth tax, is something that's potentially on the agenda, and something that clients need to consider, and we obviously can factor that into plans. So I think the main things being here really is it's to sort of like echo, we obviously don't know in terms of no crystal ball and what's going to happen, but certainly for certain clients, if they're not sure, it's worth having a conversation with us just to see what that means for them, and whether they should actually be taking action in their particular scenario, if only just to give you the peace of mind that you're thinking of all the right things. Okay, so I'm just going to give a bit of an overview of our advice service and charges. Okay, so Fred's pretty much covered lots of this, but just to give you a bit of an overview again. So firstly, I think the first thing to really share is any initial call or meeting you have with us. So, if you wish to contact us to discuss some of the points we've covered today on advice@netwealth.com, is any initial call is completely complimentary, no obligation. Happy to have a friendly call about your situation, and see, whether we can help, whether you need advice, whether it's right for you, or if only just to give you that peace of mind that you need to make sure you're on the right track. All of our advice is regulated, so all of our advice is a form of a financial plan. It's a formal documented report. In terms of the typical areas which we advise on, so asset allocation, making sure you're taking the right level of risk in your portfolio, and as Fred's mentioned earlier, that can be a combination of risk profiles and different parts of your portfolio. Typically, it could be that you should be taking more risk with your pension and a lower level of risk with the assets, like the GIA, general investment account, and the ISA that you're drawing on. And it could be that your risk profile should change over time, either as you're sort of drawing down more, or as your appetite for risk changes. We also look at income analysis, so there'd be a period in time which you've got surpluses, and making sure that you're investing in the right way. And then obviously at the point when you're needing to draw down, we will advise on that. In terms of retirement planning, so this is a typical area we advise clients on. So one of the sort of key questions a client asked is, when can I retire? When can I afford to retire? And quite often or not, it's quite a useful exercise for clients to know that, even if they are maybe a few years off of retirement, because you tend to find that once clients know what that point of time is when they can afford to retire, and it could well be now, it gives them a sort of sense of financial freedom, knowing that they can then retire at a point which is sort of that determined by them. They've got financial freedom, and sometimes that means they actually carry on working for a bit longer than otherwise. So we can help clients know where they are at that point. And then obviously just making sure clients are saving for retirement in tax efficiently. So making use of their various allowances. So pension planning, making sure they fully utilising their pension allowances, making sure they're using the fully use of their ISA allowances and various other tax allowances. Fred's also mentioned in terms of pension consolidation, we tend to find that when clients come to us, or prospective clients, that they have various pension pots which they've accumulated from various employments. So we can help analyse those, look at the different costs and features, look at the charges that they're currently paying, and then if it's the right thing for the client, make recommendations to consolidate that. And that tends to be a really useful exercise for clients, because having various pots in different places can be quite overwhelming in terms of being able to manage and adopt a coherent and holistic approach to how you invest and then meet your needs in retirement. Most of our planning usually involves wealth projections, and we can help with either that with covering school fees or care home costs in terms of planning, and then obviously that's built into retirement plans. Drawdown strategies is a key aspect, which Fred also touched on. But in terms of, not only is it important in terms of tax efficiency when one's accumulating wealth, the right drawdown strategy is absolutely key for a client. So just going into it blindly, it can make a significant amount of difference to the sort of how sustainable the client's position is over time, by adopting the most tax efficient and optimal strategy in retirement. And then another key area we help with is estate planning. So the two sort of typical objectives which clients come to us with are basically, can I meet my own needs throughout my lifetime? How do we do that? And then on the other side of the spectrum is basically thinking about estate planning. So if it looks like our wealth projections, basically there's potential assets left on the balance sheet at the end of the projections, that may lend itself to estate planning. And that's either because the client is wishing to save IHT, or there's a point in time that they're wishing to maybe help the children. And typically that might be when trying to help their children get onto the housing ladder, for example. And we can obviously run projections to help clients ascertain the affordability of certain levels of gifting. So in terms of our service, so two parts of our advice service. So the one-off advice service, so essentially we meet with clients, ascertain what they're wishing to have advice on. We provide a fixed quote of that, provide them with the one-off advisory agreement. We then provide our report, and then meet that, and then that's the end of the process. Or the ongoing advisory service, which is our more traditional service, where again the client would still receive their initial report, but then following that we'd have an ongoing relationship where we'd meet the client, meet half yearly to get an update on the circumstances, provide any recommendations because of the changes or changes in pension and pensions legislation or tax legislation, and with that service as well, we will also be in contact with the clients if more immediate action is required, if something happened that warranted the client to take more immediate action. In terms of the advice process, just how it works. So basically, we'd have an initial meeting with the clients, getting a full update on the circumstances, agree the scope of advice. We'd then prepare the advice report to the client. Once we've obtained full information of the client's situation and existing arrangements, so assets, liabilities, income, expenditure, and all of their existing pensions and investments. With all of that information, we would then prepare our formal advice report, which is typically 40 to 60 pages. Then the advice would usually be delivered in about 4 to 6 weeks. Following that, would then meet to discuss the report, present the report, discuss the conclusions, what that means for the client, and then obviously answer any questions that the client may have. Would then help the client implement the advice. So that could be changes in risk levels, how they access their pension, and maybe consolidation of existing arrangements. For the one-off advice, that would be the end of it, unless, of course, maybe in a couple of years' time, the client wishes us to refresh their plans or something's changed in their circumstances. Whereas the ongoing advice service, we'd get an update on the client's position and also cash and other assets, whether it be rental properties or other aspects of their position. Would then advise on the client on making sure they're using all of their allowances, so whether it be pension, ISA, CGT, and other allowances, making sure that we're meeting their income need in the most tax efficient way for that tax year, and then just make sure that they continue to be invested in the right way as per the sort of initial report, whether any changes are needed to any parts of their portfolio. So as mentioned earlier, so again, as part of the ongoing service, we would also contact clients if need be in the interim period, if any more urgent action is required, or if indeed something's changed in the client's situation that needs to have advice earlier. So just to give you an overview of Netwealth's fees for our services. So the top part here is our ongoing advice service. So essentially what we've got here is our investment fee. We've got 4 different fee bands for So basically 50,000 to 250 is 0.75, 250 to a million is 0.6, a million to 5 million is 0.45, and over a million 0.35%. Okay, and I must stress that includes all of these categories above. So investment management, safe custody and administration, VAT, tax reporting, transaction fees, and third-party charges. And then we've also got our ongoing advisory fee of 0.35% plus fund and trading costs of 0.3%. This includes everything. So this bottom line here is essentially the total cost of investing, including ongoing advice. So to be clear, for a client with a portfolio of £1 million, they'd be paying around 1.1%, and that is typically very cost effective versus the industry average. In terms of the one-off advice fee, it's £200 an hour, and just to give you an idea, a typical retirement advice report would then typically be 10 to 12 hours of work, so 2,000 to 2,400 pounds for the work. So how to get started with Netwealth? So just to conclude, so just mindful of time. So I think the first thing really to do is just have a bit of a think about where you are in your current situation. So what assets and liabilities you've got. So with property, rental properties, pensions, ISAs, your income and expenditure, both now and what it might look like in the future. And we obviously can help you with thinking about those with a conversation. Think about what your objectives might be both now and in the future. Are there any particular alternative scenarios that you may wish for us to model? So quite often, as I've mentioned, clients may think about at some point, maybe 10, 15 years down the line, they may be wishing to downsize or help the children with some one-off gifts. And we can absolutely be modeling for all of these different scenarios and help clients to ascertain what that may look like for them in the future. And then the one final thing is quite often it is to a good idea to bring family members into these conversations, so that there's a level of family planning, succession planning. We've not mentioned it, but one thing we do have at Netwealth is something called the Netwealth Network, where family members can be all part of the same network. Assets are completely segregated in terms of visibility, but assets are then aggregated for fee purposes, so that you all benefit from being on the same fee band and helping family members save and invest in a very cost-effective manner. So once you've had a think about that, I think the main thing is really just to get in contact with us, and we can have a helpful and friendly conversation around your plans to see how we may help. So just in summary, in terms of Netwealth and our services, so basically financial planning is about, it can be suitable for an array of clients. It can either be because a client's affairs is particularly complicated, and therefore they do need the experience of a financial advice, someone to help them, or indeed it could just be someone with more simpler affairs, but actually they do need that help in hand. They're maybe not confident on what they're doing, whether they can keep on top of pensions and tax legislation, and they just need that oversight and help with that. So that's another area we can help with. In terms of the areas we help with, it could be saving and drawing down efficiently, making sure you're invested in the right way, and estate planning. And I think the main thing really being is, financial planning, as Fred sort of explained earlier, can make a huge difference to someone's situation and how their assets, can meet their needs just through optimization, in terms of whether it be when accumulation stage or drawdown stage. So I think, just to conclude it, if I think it'd be good if people get in contact. We're very happy just to have a conversation. So email through to advice@Netwealth. We can arrange those calls and then see how we can help you with your financial planning, or just to give you the peace of mind that you may need. But otherwise, thank you ever so much for joining us today. I'm mindful of the time. Sorry, just a couple of minutes over time. But if anyone does have any questions, drop them through to advice@netwealth.com, and then either myself or Fred or one of the members of the advisory team will pick that up, and we can obviously arrange a time to speak. So thank you very much for joining. It's been great, and we look forward to speaking with you soon. Thank you.
Thank you all. Thank you, Gary. Hope you all enjoyed that, and we look forward to speaking to many of you soon. Do email us. The email address is at the bottom of the page there, advice@netwealth.com. Enjoy the rest of your afternoons, everyone, and thank you very much for joining.
Thank you.